This is Nightly Business Report with Tyler Matheson and Sue Herrera.
We're bringing back jobs. We're bringing down your taxes. We're getting rid of your regulations. And I think it's going to be some really very exciting times ahead.
Music to the market's ear. The Dow has its best day of the year as the Trump administration's financial deregulation efforts get going. Hiring spree. Job creation was hot in January. Wages were not, giving the Fed little reason to pick up the pace of rate hikes. Trash talk. Lots of people do it while watching sports, but add in some emojis and you have the bright idea to start a business. Those stories and more tonight on Nightly Business Report for Friday, February 3rd. Good evening, everyone, and welcome. I'm Tyler Matheson. Sue Herrera is off tonight. Well, Wall Street levitated into the weekend. Stocks got a big lift on what investors see as gifts from Washington. First, regulatory rollbacks. The White House today took the first steps to scale back rules put in place after the financial crisis to govern bank behavior. Those rules, criticized by bankers as too complex, too restrictive, aimed to keep taxpayers from becoming the ultimate backstops for bad risk-taking. Then there was a wide-ranging and clearly friendly discussion between President Trump and U.S. top business leaders. Add to that a strong month for job creation, and boy, do you ever have a recipe for a triple-digit gain. The Dow Jones Industrials rose 186 points, back above 20,000 at 20,071. NASDAQ closed at a record high, up 30, and the S&P 500 added 16. Meanwhile, back at the White House, those first deregulatory steps came in the form of an executive directive. President Trump signed an action today that directs the Treasury Department and regulators to come up with a plan to revise some of the banking rules under the so-called Dodd-Frank legislation. They were put in place back in 2010. And of course, Wall Street likes less regulation. And there, the president showing off his order. Well, that signature helped lift financial stocks today, which in turn helped the broader market. Separately, the Labor Department is now looking into delaying the implementation of a new retirement rule. This after President Trump today called for a review that could ultimately lead to scrapping it. The rule in question was developed under the Obama administration and calls for retirement advisors to work solely in the best interests of their clients, the so-called fiduciary standard. It sounds simple, but it's actually very controversial. Dominic Chu explains.
There are a lot of ways people save for their retirement, and there are a lot of financial products and investments that serve that purpose. But when it comes to the investment advice side of things, there are currently two acceptable ways for professionals to give it to you, based on suitability and/or based on your best interests. Currently, brokers, insurance agents, and some others advise clients on their investments based upon what's suitable, given things like their yearly income, their tolerance for risk, that's among other things. They typically get paid some kind of commission or sales charge for facilitating the transaction. Other investment advisors have to put clients only into investments they think are in a client's best interest based on things like fees or complexity of the investment. These advisors typically charge a fee based on the amount of assets they help advise on. Enter the Labor Department's proposed fiduciary rule, which would require that anyone advising on a person's retirement investments to only act in the client's best interests. Seems like a slam dunk, right? But consider this. Proponents of the fiduciary standard say that it will help save retirement investors a lot of money on commissions and reduce conflicts of interest when brokers get paid to sell certain types of products. Opponents say that the rule takes away a slew of investment options currently available and force many investors to pay a fee based on assets managed, no matter how many trades are made, as opposed to just a sales charge when trades actually happen. Those are just a handful of the many arguments being made on both sides of this debate. For Nightly Business Report, I'm Dominic Chu.
Well, now that fiduciary rule is in question, what will it mean for investors and their retirement accounts? Todd Rosenbluth is Director of ETF and Mutual Fund Research at CFRA, joins us now to discuss. Todd, welcome. Good to have you with us. Let's step back just a little bit here because some people might find it curious that the Labor Department is involved in making rules governing my financial assets. Why is that?
Yeah, so because retirement programs are often part of 401k plans are something that's part of what you have while being employed. I have that at my company. I'm sure you and your viewers have it as well. It's something that falls under them. And it's really something that investors need to be mindful of what's happening in their investment portfolios because retirement is coming sooner versus later for many of them.
What about the criticisms that Dom just touched on, and that is that by promulgating this fiduciary standard, the result will be less choice for investors, number one. Number two, that there will be fewer kinds of investments available to them. And number three, that some people, particularly lower income people, won't be able to get investment advice.
Well,
how do you address them?
Right now, we've got about 2,000 mutual fund share classes. We've got 2,000 ETF share classes, 23,000 mutual fund share classes that we at CFRA cover. There's a lot of choice that's out there. Reducing some of that and taking away the more expensive and underperforming products away from those clients would be in their best interest. So this would be a good thing if they found cheaper alternatives, more index-based alternatives that's out there. And you can still choose those products if you do it on your own. So yes, you may have to work on your own to do homework and build your own portfolios without a financial advisor. But there's lots of programs, robo-advisors that are out there that can help you to do that as well.
Now, let me just, you favor the idea that this standard ought to stay in place as a general rule. Forgive me for being cynical here, Todd, but I wonder whether at the bottom of it all is a concern on the part of financial practitioners that if this standard were put into place, that they are going to be the target of one lawsuit after another if they put an investor into a higher-priced investment that doesn't work the way it might theoretically be told to work. Is that really what's driving this?
So there certainly is that fear that's out there. And the way to perhaps overcome that fear is to make sure as an advisor you're doing your homework, you've done the due diligence, you've got a lot of supporting information to be able to justify to your client why you have that. And whether this rule is in place or not, that's what an end investor should be looking for. That the end products in their portfolio suit their needs, whether there's a Department of Labor rule or not. Knowing what's inside your portfolio and how it's going to help you achieve your goals is extremely important.
All right, Todd, thank you for the clear explanation. We appreciate it. Todd Rosenbluth with CFRA. Well, as we said at the top of the program, the first employment report released under the Trump administration showed solid gains. The economy created 227,000 jobs in January, more than expected, largest gain in 4 months, by the way. The unemployment rate did inch higher to 4.8%, but wages rarely budged, rising just 0.1%. And as Hampton Pearson reports, the latest report points to a tightening labor market.
2 weeks after taking the oath of office, President Donald Trump got some good news about the Main Street economy.
227,000 jobs, great spirit in the country right now. So we're very happy about that. I think that it's going to continue big league. We're bringing back jobs. We're bringing down your taxes. We're getting rid of your regulations. And I think it's going to be some really very exciting times ahead.
Headline unemployment went up to 4.8%. But that was because nearly 500,000 people who had been on the sidelines started job hunting in January, enough to boost the closely watched labor force participation rate to 62.9%, the highest since September.
There's more momentum in the economy, and I think it predates the election. I think we have seen, it was a convincingly strong jobs number, both in the establishment survey and in the household survey.
The private sector led the way, with employers making 237,000 new hires, and the job gains were widespread. Retailers adding 46,000 employees, construction up 36,000 new workers, restaurant and food services another 30,000. Only the government sector saw a decline, losing 10,000 employees.
The construction number is consistent with the view that we're kind of making America great again, right? That we got a friendly business climate and people want to come back and start operating their businesses here, and you're starting to see that in the data.
For all the positive trends, wage growth remains a weak spot. Average hourly earnings barely rose last month, and December's average was revised downward, despite the fact that some 19 states increased the minimum wage at the start of the year.
The last 2 years have actually been pretty strong wage growth for let's call it the middle of the income distribution for the first time in 25 years or something. And it'll be interesting to see whether this continues.
Now, the early consensus among Fed watchers is that lack of wage pressure has lowered the odds for a rate hike in March. But today's jobs report shows improving prospects for more jobs and, yes, higher wages. For Nightly Business Report, I'm Hampton Pearson in Washington.
Well, also in Washington, the businessman turned president met with the people who run some of America's biggest businesses today. On the agenda, issues that President Trump campaigned on, like taxation, regulation, job creation. Eamon Javers reports from the White House.
A president who campaigned as a titan of business welcomed his fellow moguls to the White House today for the first meeting of his business-focused strategic and policy forum.
We're looking forward in a little while, in the upcoming few moments, to discuss all of the things that you think we can do to bring back our jobs, to get taxes even lower than we're going to be cutting them. We have a great plan, but I want to have your input on the plan in particular, and to do what we have to do in terms of regulation.
That's music to the ears of many of those in attendance at today's meeting, which included executives from Walmart, IBM, General Motors, JP Morgan, and even Tesla.
I've been coming down here since 1980 in these meetings, and this is the first one where I had an engaged president deeply into it. This was the most exciting presidential meeting that I'd ever been in.
But not everyone wanted to be in the room with President Trump. The day before, Uber CEO Travis Kalanick announced he would drop out of the CEO group in the wake of controversy over Uber's response to the president's executive order on immigration.
I think Travis was in a really difficult spot. His business was being very adversely affected. He had discontent among his employees, and this group actually takes a lot of time. Right. And he basically said, I'm encountering just too much in the way of headwinds, and would you mind if I step down?
The executive said the group would be convened monthly at first and then quarterly as a way to keep ideas coming to the Trump White House on everything from taxes to immigration to trade. For Nightly Business Report, I'm Eamon Javers in Washington.
The Treasury Department today imposed new sanctions on Iran. This as the new president moves to punish that country for a recent ballistic missile test launch. The sanctions apply to 13 individuals and entities based in Tehran, the United Arab Emirates, Lebanon, and China. In response, Iran said it will take actions against a number of American individuals and companies. It did not, however, name the targets of its sanctions. The Department of Defense and Lockheed Martin have agreed on an $8.5 billion deal for 90 F-35 fighter jets. That is the lowest price to date for the Pentagon's program. The deal brings the price per jet below $95 million for the first time ever, for a total savings of more than $700 million. And still ahead, a trip to Louisiana to see where the jobs are.
Donald Trump's plan to invest in American infrastructure is welcome news for the already booming construction industry. That's coming up on Nightly Business Report.
Fixing our aging infrastructure. It's a big promise of the Trump administration, of course, and if everything goes as many hope, all of that spending will create a lot of demand for workers. Kate Rogers went to Hackberry, Louisiana, to see where the jobs are.
President Trump is promising to rebuild America in a big way.
Our infrastructure is in serious trouble. We will build new roads and highways and tunnels and airports and railways across the nation.
These promises are good news for the already booming construction industry, which is as optimistic about its outlook as it's ever been. According to a recent survey, 73% of general contractors plan to add workers this year, but that's only if they can find skilled labor.
There are no longer a lot of experienced workers sitting on the sidelines. Now contractors hiring people without construction experience or first-time job entrants.
Chicago Bridge and Iron has been at the forefront of the industry comeback with the boom of energy infrastructure construction in the Gulf Coast. Operations like this $6 billion Cameron liquefaction project require thousands of workers and underscore CB&I's hiring needs. In fact, this year they plan to bring on 15,000 workers in the Gulf region alone.
The workload is increasing. We envision about $40 billion more spend over the next few years. In fact, this wave of demand for workforce should continue well beyond 2020 into 2025.
CB&I's CEO says the company has around 100,000 people in its database, but finding workers with the right skills can still be a challenge. To close the skills gap, the company has been expanding its veteran recruiting as well as partnering with technical and vocational schools to create customized programs.
We have roughly an 87% graduation rate and have made offers to at least 75 to 78% of those on our jobs.
Stay-at-home mom Teresa Horner participated in a welding course at a community college a little over a year ago, graduating top of her class. Today, she makes more money than her husband as a structural welder for CB&I.
You can make some really good money and be able to support a family and, heck, even be independent if you're that kind of woman.
Horner says the potential for more infrastructure spending gives her a sense of stability that she'll be employed for years to come. Now workers like her and the industry in general are waiting to see if the president's words will translate into action.
There's the potential for seeing a lot more construction, figures as high as $1 trillion over 10 years. I think there's a strong, let's see how it would be structured and how it would be financed attitude.
For Nightly Business Report, Kate Rogers, Hackberry, Louisiana.
To read more about the future of construction jobs, head to our website, nbr.com. Well, Macy's and Saks could soon be under the same roof. And that's where we begin tonight's Market Focus. Yesterday, we told you that Macy's might be for sale, and today, multiple reports say that the Canadian-based Hudson Bay, which owns Saks and Lord & Taylor, has entered into early talks with Macy's about a potential buyout. The two companies are also said to be discussing other ways to work together, including a possible real estate transaction. Shares of Macy's surged 6% to $32.69. The oil refiner Phillips 66 said challenging market conditions caused the company to post a profit that was sharply lower than estimates, but revenue did rise, and that beat expectations. Shares, though, off 1% at $79 and $95. Hershey posted a better than expected profit, but saw sales come up short as the company faced weak demand in its China market. The maker of Reese's Peanut Butter Cups and Hershey Kisses also said it would roll out new products this year and gave upbeat earnings guidance for 2017. Shares up 1% at $106.98. AutoNation said it had record earnings for the quarter, but results still missed estimates by a penny. The nation's largest auto retail chain also posted weaker than expected sales. Shares down nearly 4% at $49.77. Now to our market monitor, who likes companies he says are experiencing growth in what he calls a lackluster economic environment. This is his first time joining us on the program. Bernie Williams, welcome. He is the Chief Investment Officer of Investment Solutions at USAA. Bernie, good to see you again. We've met before separately. Let's go right to your stock picks. A couple of them have a common thread, but let's start with NuVasive, which is a med tech company. What does it do? Why do you like it? Do you have a price target on it?
Yeah, so NuVasive is a med tech company, and what they do is manufacture components for spinal surgery. Specifically, it's minimally invasive spinal surgery, along with some software that allows the physicians to more finely align the spine during the surgery. They're growing at about twice the market for that. That's one reason we like it. The other reason we like it is because they've got a new CEO, and the company we think has probably been a little undermanaged in the past. So there's a lot of opportunity for margin expansion. And so you have a company that's grown twice as fast as the market, good opportunity for margin expansion, and as you said, med tech, so they're not in that bullseye of or storm of pharma pricing right now. So that's why we like this company.
And the next two picks are basically chip equipment makers. Let's begin with pick number one, which is Lam Research.
Yeah, so Lam Research is a semi-equip manufacturer, and they make equipment that enables 3D, NAND, and DRAM chips. These are chips that go into, among other things, cell phones. And so what you're seeing is a big trend, especially in 3D NAND, for increasing memory ability. So you see cell phones that have 256 gigabytes. They rival laptops and PCs right now for memory capability. We still think that market is expanding next year. Now, realize this is a cyclical industry, but we see good potential for this market through 2017, given the expansion of the cell phone market and the Chinese, which are expanding their manufacturing in this.
Pick number 3 is another equipment maker, Applied Materials, or AMAT. They're in a different sliver of the market.
They do. Now, they have the same exposure to 3D NAND and such, but they also make equipment for the OLED or organic light-emitting diode market. So this is the surface that goes on the Samsung phone and that will go on the new iPhone 8, at least that's the rumor. But what's also interesting is this will actually come out, this is coming out in TVs. LG has a TV out with this right now. Sony has announced one for 2017. And I think this is where a lot of TV manufacturers will move to in the coming years. I think this has a long tailwind to it as consumers adopt it. And it is materially better technology than the current LCD technology that's in 4K TVs.
Bernie, great to see you.
Thank you.
Thanks so much. Bernie Williams with USAA. All righty, coming up, meet a former college football player who wanted to cash in on his love for sports, but instead tapped into the emotions of fans everywhere. And that was his bright idea on how to start a business. We'll tell you about it. Some positive news on retirement. Savings are at an all-time high. According to Fidelity Investments, the average 401k balance hit a record of $92,500 at the end of last year. Fidelity attributes the increase to rising stock prices, they always help, and more contributions. Well, let's come to this. Friday night, Super Bowl weekend, and one young entrepreneur from Miami, still in his mid-20s, who got the bright idea to give fans using his app to help them find the latest sports news, a chance to communicate with their friends, trash talk with fellow fantasy leaguers, using animated emojis representing some of the biggest names in sports.
I was thinking about myself as a sports fan.
Vicente Fernandez loves sports, but this former high school and college football player was surprised when his mom called early in his freshman year at the University of Chicago.
She is not the biggest sports fan I know. And she calls me and she says, "Hey, Vicente, I want to start a sports website together."
His mother, a Cuban immigrant who grew up in Miami, is a career advertising exec.
One of the most coveted audiences for marketers is the sports fan. Because the sports fan is so loyal and so fanatical, every top-tier brand will try to tap into that.
So they launched Sports Manias in 2012. Fans follow any teams they want for free and get a personalized feed, mostly tweets from media sites, from writers, and from teams. In 2013, they added an app. Then came the hard part.
Getting someone to download an app is not easy. That is incredibly valuable real estate in a person's life.
It wasn't until 2015 when Fernandez noticed the NBA's Atlanta Hawks had an emoji keyboard.
It was the first time I'd ever heard of anything like this in sports.
So he added NFL emojis in 2015. They didn't move until a promotional video showed emojis moving in familiar poses. His customers, sports maniacs, began clamoring for them. Within weeks, Fernandez built what he says is the world's first animated sports emoji keyboard. Texting with Aaron Rodgers doing his championship belt, no problem. Facebook message with Odell Beckham Jr., why not?
We saw so much success, we expanded it beyond football.
Sports Manias began ranking with the big boys, CBS Sports, ESPN, the NFL on Super Bowl Sunday in 2016. For one day, Sports Manias beat them all.
At that point, we knew we'd hit something that was going to change the sports media industry.
Almost overnight, the customer base grew from tens to hundreds of thousands. The NFL Players Association partnered, introducing Sports Manias to the hatmaker Lids, which now pays Sports Manias so it can embroider the emojis on caps. And why not? The emojis were shared more than 2.5 million times during the NFL's regular season. Most popular, Carolina Panthers quarterback Cam Newton. Beckham was second. Atlanta's Julio Jones tied for fourth. In the playoffs, Jones and Tom Brady are leading.
That's literally how he walks around.
Through a new partnership with the National Football Foundation, there are College Football Hall of Fame emojis like Marty Lyons and Alabama star in the 1970s.
I just turned 60. I think this is neat. You give it to a 7-year-old and they're going, wow, that's really neat. So the range that you can connect with is endless.
This weekend, Papa John's Pizza's buying in, sponsoring not only the NFL and Super Bowl 51, but also the Sports Mania's emoji keyboard. It's not yet profitable, but the potential is there to build a business with global reach.
We got a request for a Lebanese soccer team emoji and a South Korean soccer team emoji. From all corners of the world, these sports fans come.
Well, he's already got some European soccer emojis. There are literally hundreds, but only one designer making them. He's located in Georgia and is one of 18 full-time employees scattered around the country. App users can even make emoji requests like this one. Let's get get some motion there. Well, I love it. That's Nightly Business Report for tonight. I'm Tyler Mathisen. Sue's off. Have a great weekend, everybody. Enjoy your weekend. Enjoy the football game if that's your pleasure. We'll see you Monday.